Hi, this is Professor David Lopez. I'd like to welcome you to Financials for Entrepreneurs, Part 2. In this podcast, I will discuss several important financial statements used by entrepreneurs to make decisions regarding their business. The main focus of today's podcast will include the balance sheet, income statement, and cash flow statement. Although we're not going to focus on the balance sheet in a large fashion for this meeting, I still want to review the items that appear on the balance sheet. Several of the common items appearing on a balance sheet include current assets, fixed assets, depreciation, current liabilities, long-term liabilities, net worth. The formula for creating a balance sheet is assets minus liabilities equal net worth. These financial statements are tools used by entrepreneurs to make strategic as well as tactical business decisions. As an entrepreneur, you don't have to be a CPA to understand and use this data. The information gleaned by the balance sheet, income statement, and cash flow statement come from numerous transactions undertaken on a daily, weekly, and monthly basis. All the information comes into play when creating these reports. Let's focus on the income statement. The income statement shows how a business is performing over a specific period of time. Some of the items that you'll find on an income statement include total sales, discounts and returns, cost of goods sold, gross margin, operating expenses, interest and taxes, and of course the bottom line. The basic formula for an income statement reads as follows. Starting with gross sales, subtract returns and allowances, and this leads to net sales. Subtract cost of goods sold, and this leads to gross margin or gross profit. Subtract operating expenses, and we're left with operating income or operating loss. Subtract other income or expenses, and we come up with a pre-tax income or loss. Subtracting taxes, we arrive at net income or net loss. Switching gears to the cash flow statement. The cash flow statement shows change in free cash on a daily, weekly, monthly, quarterly, or yearly basis. The basic cash flow formula is cash in less cash out equals net cash balance. The steps include reviewing operating activities, reviewing investing activities, reviewing financing activities, and then calculating cash flow. For the balance sheet, cash flow statement, and income statement, the question is, where do the numbers come from? These numbers come from transactions made by management or other employees. They're then entered into journals, whether it's payroll, disbursements, receipts, sales, or purchases. They're then compiled into the general ledger's chart of accounts and then summarized into a financial statement presentation. Obviously, there are a number of different software programs available, and it always, of course, does make sense to get a good CPA. I want to finish up with a review of accrual versus cash accounting. Accrual accounting covers the lag when a sale is booked and when payment is received. It occurs when the event occurs from an accrual accounting perspective. Cash accounting occurs when revenue and expenses are booked and when cash changes hands. The key difference is timing. Most businesses do not work on a cash basis. They usually have accounts payable and accounts receivable to deal with, and they tend to choose the accrual method of accounting. This has been Professor David Lopez. Thank you for listening.